Have you ever truly allowed your hard-earned money to simply be, without constant worry or the pressure to perform? I'm not referring to leaving funds in a low-yield checking account, barely earning interest, and mistaking that for true financial security. Let's be candid. Parking your capital where inflationary forces relentlessly diminish its value isn't rest. It's a form of neglect. Similarly, constantly monitoring your investment portfolio every few minutes, as if it were a vital sign monitor, isn't a sound strategy. This obsessive checking is merely anxiety amplified through a brokerage application, not a thoughtful approach to wealth management. And impulsively buying into any cryptocurrency or stock trending on social media, solely because an online personality endorsed it? So today we're going to discuss something your finances desperately need, yet you've likely never truly provided it. We're talking about genuine financial repose, allowing your assets to achieve a state of true, productive calm. That frantic energy, constantly checking your brokerage app, often stems from anxiety, not a sound financial plan. Blindly chasing the latest trending stock or cryptocurrency, simply because some flashy online guru advised it, isn't genuine investing. It's just gambling with extra steps. Today, we're going to discuss something vital your money desperately lacks and has never truly experienced: genuine tranquility. Our society often treats money much like people, believing it must always be active, hustling, or trading to avoid falling behind. However, there's a crucial truth few will tell you. The world's wealthiest individuals didn't amass their fortunes through relentless, exhausting activity. Instead, they built their wealth by strategically placing their funds in intelligent investments and then allowing them to grow undisturbed. Your financial assets don't require an additional hustle. They need a peaceful, stable place to reside, like a comfortable hammock. By the time this video concludes, you will possess the precise knowledge to construct such a secure and restful environment for your own money. Let's face the common reality of how many of us handle our finances. We often allow significant sums to simply accumulate in a checking account. I understand the appeal. It feels secure and accessible, right there for you to monitor and use whenever necessary. Yet, that money isn't truly resting. In fact, it's slowly diminishing in value. Consider this. If your checking account offers a meager 0.01% interest rate, while inflation steadily climbs at 3, 4, or even 5%, this means your hard-earned money is literally losing its buying power with each passing day it remains stagnant in that account. Such a scenario isn't responsible saving. It's merely observing your financial resources steadily erode. You are effectively watching your ability to purchase goods and services decline over time, rather than grow. Yet, there exists an entirely different approach to managing finances, one that focuses on relentless, ongoing activity. These are the individuals who believe that effective money management necessitates constant intervention and engagement. You might recognize this particular financial personality, or perhaps you even identify with this very active style yourself. This often manifests as frequently refreshing your investment application, perhaps multiple times even before lunchtime. They might hastily sell off a stock, reacting purely to a slight 2% dip on a random weekday. Another characteristic is diving into the latest trending meme coin, solely based on a casual tip from a coworker's distant cousin. Their financial strategy involves an almost continuous circulation of funds, constantly moving them around. This includes frequently transferring money between various bank accounts and different investment platforms. They also tend to migrate assets and switch between diverse financial strategies, never quite settling on one approach for long. The downside of all this motion is that you often end up spending a significant amount on cumulative trading fees. Moreover, this constant vigilance and decision-making can lead to considerable financial stress and anxiety. Ultimately, by the close of the year, the expenses from these fees and the burden of stress often outweigh any actual financial gains. Now, here is a rather unpopular truth that many people prefer not to acknowledge regarding their financial habits. All that bustling activity, that perceived financial hustle, is for the most part actually quite inefficient. In fact, much of this relentless effort turns out to be entirely counterproductive to their long-term financial goals. We're now focusing on another segment of individuals who mistakenly believe that effective money management requires constant intervention and activity. You might recognize them, or perhaps even identify with them, always refreshing their investment applications multiple times before noon. They are quick to sell a stock if it experiences even a minor dip, reacting impulsively to every market fluctuation. These individuals might also jump into the latest speculative trends, like a meme coin, based on casual advice from acquaintances. Their financial habits involve incessantly moving funds between various accounts, platforms, and investment strategies. By the close of the year, the accumulated trading fees and emotional strain often eclipse any actual financial gains they've made. Now, we confront a difficult truth that many are reluctant to accept about their financial behavior. Despite all this diligent activity and perceived hustle, more often than not, it actually hinders rather than helps their financial well-being. Numerous studies consistently indicate that the more frequently people engage in trading, the poorer their investment returns tend to be. This isn't due to a lack of intelligence, but rather an underlying restlessness. They simply cannot leave their investments untouched. They frequently mistake mere motion and activity for genuine financial progress and advancement. Then, there's a third distinct group, those who completely avoid managing their money, often called the avoiders. These individuals acknowledge the necessity of addressing their finances, but the entire prospect feels so overwhelming that they simply do nothing. They perpetually postpone action, telling themselves they'll tackle it next month, or after a raise, or once a specific debt is cleared. Consequently, next month stretches into a next decade, allowing the most potent financial ally, time, to slip away. Regardless of whether you're neglecting, exhausting, or completely avoiding your finances, the ultimate outcome remains unchanged. In each scenario, your capital is prevented from fulfilling its fundamental purpose, to labor diligently and accumulate wealth steadily. It should be quietly growing, steadily compounding its value over extended periods. Instead, your financial resources are effectively tired, unable to perform as they should. It's time we address this issue and revitalize your money's potential. So, what exactly does it entail for your money to truly rest and function optimally? The fundamental principle is this: genuine financial rest doesn't equate to complete inaction. Rather, it involves strategically positioning your funds in appropriate investments. Then, you must afford them the necessary time and undisturbed environment to expand. This means allowing growth to occur naturally, without your continuous intervention or disruption. Consider it akin to the process of planting a tree in your garden. You wouldn't continuously unearth its roots every single week just to verify its progress. Instead, you provide it with essential nourishment like water. You give it the proper conditions to thrive, trusting that growth will happen organically over time. You ensure it has what it needs to flourish. Whether you ignore, deplete, or completely shun your finances, the outcome remains identical. Your funds are prevented from fulfilling their true purpose, quietly working, steadily increasing, and compounding over time. Effectively, your capital is exhausted. It's time we actively address this critical issue. So, what exactly does it entail for your money to achieve proper, restorative rest? The crucial insight here is that true financial rest doesn't involve idleness or inaction. Instead, it means strategically positioning your assets and allowing them ample time and room to expand undisturbed. With this understanding, let's now delve into the practical options available for your money's well-being. First up is the emergency fund, which serves as your money's secure and vital resting place. Prior to allocating funds elsewhere, they require a secure sanctuary, and that's precisely what your emergency fund provides. This involves setting aside 3 to 6 months' worth of essential living costs into a high-yield savings account. Crucially, this isn't your standard checking account, but rather a high-yield option offering returns of 4 or even 5%. This designated amount forms the absolute bedrock of your financial stability. Its primary role isn't rapid expansion, but rather immediate availability for unforeseen life events. This includes unexpected medical expenses, vehicle repairs, or even a sudden loss of employment. This capital isn't dormant. It's actively poised for action. Imagine it resting in a hammock, one eye open, ready yet calm. Beyond this secure base, we then consider index funds, representing a more gradual, deliberate financial journey. This particular approach to investing isn't designed to be glamorous or particularly thrilling. You won't find viral social media content celebrating the simple act of buying an S&P 500 index fund. However, there's a crucial truth often omitted from those sensational videos promising overnight wealth. In reality, this seemingly unexciting investment method has consistently surpassed the performance of many. It has proven more effective than the vast majority of experienced professional fund managers. This superior track record holds true when viewed over an extended period. We're not talking about gains realized within a single year or even half a decade. Its true strength and consistent outperformance become evident across multiple decades. An index fund systematically allocates your capital, distributing it broadly across hundreds of diverse corporations. This inherent diversification significantly reduces the specific risk associated with individual companies. It essentially communicates a reassuring message, freeing you from constant financial worry. This approach liberates you from the task of selecting individual, high-performing stocks. Furthermore, you are spared the stress of attempting to predict optimal market entry and exit points. Such simplicity is a core advantage, allowing your investments to grow passively over the long term. In contrast to flashy schemes, index funds represent a steady, unexciting path, much like a quiet stroll in the park. You won't find viral videos celebrating S&P 500 index fund purchases, unlike those turn $500 into $50,000 narratives. Yet, despite its lack of glamour, this world's most understated investment strategy has consistently surpassed most professional fund managers. This isn't a short-term phenomenon, occurring over just a year or 5. Its superior performance spans many decades. An index fund intelligently diversifies your capital across hundreds of companies, essentially saying, "Don't worry, we're handling this." You are thus freed from the pressure of identifying winning stocks or perfectly timing market entries and exits. By investing a fixed amount regularly, known as dollar-cost averaging, you allow the passage of time to do the heavy lifting. Your money, though seemingly at rest, ends up working far more effectively than most people's active investments ever will. Next, consider dividend investing, a powerful concept where your money earns income even while you sleep. This particular investment strategy is, in my opinion, one of the most compelling to explain and understand. Imagine your funds engaged in a small part-time job, bringing home a paycheck every quarter, which then immediately buys more shares. This continuous cycle of earnings used to acquire additional assets is precisely what we call dividend reinvestment. It begins when you purchase shares in a company that routinely distributes a portion of its profits to shareholders. These received dividend payments are then automatically used to buy even more shares of that same company. Consequently, those newly acquired shares generate even greater dividends, which in turn purchase more shares, perpetuating a powerful growth loop. This strategy allows you to delegate the strenuous work to time itself, letting it do the heavy lifting for your investments. Your capital isn't just sitting idle. It's actively toiling away, often outperforming the efforts of most other financial endeavors. This is the essence of dividend investing. Your money generates income even as you sleep, working tirelessly in the background. As for me, this particular financial principle remains my absolute favorite to articulate and demonstrate. Visualize this entire process as a snowball gaining momentum, steadily growing larger as it rolls effortlessly down a hill. Your funds aren't merely stagnant. They are perpetually resting and concurrently expanding, creating more wealth. There's no need for dramatic interventions. Your money simply multiplies discreetly in the background while you live your life. Now, let's turn our attention to bonds and treasuries, which often reside in a state of financial quietude. Consider bonds the serene, meditative aspect of the investment landscape, offering calm amidst potential chaos. You won't hear people boasting about their treasury bill yields at social gatherings, nor do they become party conversation. Yet, despite their lack of glamour, these instruments fulfill an exceptionally vital role within a portfolio. They are characterized by their unwavering stability and consistent predictability, effectively counteracting the turbulence of other assets. Picture bonds as the composed segment of your portfolio, maintaining a quiet presence while your stock holdings might be experiencing market jitters. They offer a tranquil anchor, providing a steady hand when other investments are prone to sudden, anxious fluctuations. However, it's crucial to understand that these conservative assets are not designed to rapidly accumulate vast fortunes. These assets operate quietly in the background, steadily expanding your wealth without any dramatic fanfare. They are the calm, meditative aspect of your financial plan, rarely drawing attention or excitement. You won't hear anyone boasting about their bond returns at social gatherings. They simply aren't that kind of investment. Yet, their contribution is absolutely vital, providing balance and stability against the unpredictable nature of other investments. Imagine them as the composed part of your portfolio, remaining serene even when your stock holdings are in turmoil. While they won't make you rich overnight, they are essential for protecting your capital during difficult market conditions. They might seem unexciting, but their importance to a resilient financial strategy cannot be overstated. Now, let's explore retirement accounts, where your money doesn't just rest, but enjoys powerful tax advantages. Vehicles like a 401k or a Roth IRA aren't merely holding pens for your funds. They offer a unique fiscal benefit. Within these accounts, your money grows under a special agreement where the government takes a smaller share. With a traditional 401k, you contribute funds before taxes are even calculated, deferring payment until later. Conversely, a Roth IRA involves paying taxes up front, ensuring all future growth and withdrawals in retirement are completely tax-free. Your investments compound powerfully, sheltered within a protective, tax-advantaged environment. This isn't just passive growth. It's like your money is relaxing in a luxurious, tax-exempt suite. Beyond these, another significant asset class where money can grow is real estate, often appreciating steadily. This means your capital resides within a tangible, physical asset that naturally tends to increase in value over time. Beyond just appreciation, real estate also offers opportunities for generating consistent income streams. For instance, owning a rental property provides you with reliable monthly payments from tenants. Similarly, investing in real estate investment trusts, or REITs, distributes regular dividends directly to you. Thus, your money benefits from both the steady income it generates and the underlying asset's typical growth. It's as if your wealth literally finds a secure roof over its head, protected and productive. Now, a crucial common thread runs through all these effective wealth-building strategies we've discussed. The essence is simple. You establish these investments, then consciously take a step back from constant interference. This approach means refraining from micromanaging every detail or succumbing to market panics. Instead, you empower the formidable forces of time and compounding to perform their extraordinary work. Considering how remarkably effective this passive resting of money can be, a compelling question arises. Why then, despite its proven benefits, isn't this strategy universally embraced by everyone? The answer often delves into human psychology and our natural inclinations regarding finances. It frequently stems from the inherent difficulty in consistently applying long-term financial discipline. Many struggle with the patience required to let wealth grow, often tempted by short-term impulses or anxieties. Consider real estate investment trusts, or REITs, as a prime example of your capital passively growing. Here, your funds are securely held within tangible assets that naturally increase in value over time. all while generating steady income. Just as a rental property yields monthly rent, a REIT consistently provides you with dividends. Crucially, the underlying real estate itself typically appreciates, metaphorically giving your money a solid foundation and protection. The common thread among these effective strategies is simplicity. You establish them once, then withdraw from active management. There's no need to micromanage or succumb to panic. You simply allow time and the power of compounding to perform their inherent functions. If this method of letting your money rest is so potent, why isn't it universally adopted by everyone? The answer mirrors why people often struggle to rest their bodies. It simply feels unnatural or unproductive. We are deeply conditioned, both culturally and psychologically, to equate constant action with tangible progress. This mindset leads to a pervasive belief that if you're not actively doing something, you must inevitably be falling behind. The financial industry, unfortunately, often exacerbates this tendency to the extreme. Social media, for instance, is saturated with individuals showcasing their trading screens, making quick moves, and implying that true wealth stems from speed and aggression. This constant exposure creates an unsettling pressure, an internal itch that suggests you should always be doing more. It fosters the misconception that a buy and hold strategy is only for those who lack sophisticated financial knowledge or are irresponsible with their capital. Yet, the overwhelming body of financial data consistently tells a completely different story, supporting passive investment strategies. Our inherent psychology often compels us to associate continuous action with making progress. This creates a pervasive belief that any moment of inaction means you are inevitably falling behind others. The financial sector, more than any other, powerfully amplifies this very human inclination to constantly do something. The superior long-term performance of passive investing isn't due to investors possessing greater intellect or financial acumen. Rather, their success stems from avoiding self-sabotage caused by emotionally driven, impulsive choices. Beyond this, another powerful force influencing investment decisions is the pervasive phenomenon of FOMO, the fear of missing out. Imagine a colleague excitedly sharing news about a particular stock that reportedly surged by 400% in just 7 days. Simultaneously, your social media feed overflows with countless others flaunting their impressive, rapid financial gains. This inevitably leads to an internal question. Why am I just holding on to my unexciting index fund while everyone else seems to be getting rich? However, what often remains completely hidden from public view are the substantial and painful losses incurred by many. Consider those individuals who purchased assets at their peak prices only to panic and sell them at their absolute lowest. Then there are the tragic cases of individuals who recklessly invested their essential rent money into volatile meme stocks. They subsequently found themselves in dire straits, unable to cover their basic living expenses and facing eviction. These drastic and devastating outcomes are rarely, if ever, publicized or celebrated on social media platforms. The captivating narrative of instant wealth frequently overshadows the painful and often quiet reality of financial ruin. Passive investors consistently achieve better results than active traders over extended periods. This isn't due to superior intelligence, but rather their ability to avoid self-sabotage driven by emotional choices. Another significant factor is FOMO, the pervasive fear that one might be missing out on lucrative opportunities. Perhaps a colleague excitedly shares news of a stock that surged by 400% in just 7 days. Suddenly, your social media feeds are saturated with posts from others flaunting their impressive financial gains. A thought then creeps in, why am I stuck with my unremarkable index fund while everyone else seems to be striking it rich? However, what often remains hidden from view are the significant financial setbacks and losses. This phenomenon is largely due to the powerful effect of survivorship bias, which distorts our perception. We tend to only see the triumphant investors because they proudly broadcast their successes, while those who fail remain silent. Beyond these biases, There's also a compelling illusion of control that many active investors experience. When constantly shuffling investments, it creates a powerful sensation of being in command and engaged in productive work. Yet, the feeling of being productive and actually achieving productivity are often two entirely distinct realities. In fact, sometimes the most beneficial action you can take with your investments is to simply do absolutely nothing at all. Finally, a critical barrier for many is the belief that it's either too late to begin investing or that they lack sufficient capital. They mistakenly believe investing is exclusively for those with substantial bank accounts, when in reality, the optimal time to start was years ago. However, the immediate present stands as the next most opportune moment to begin your investment journey. It's never truly too late to plant those financial seeds for your future prosperity, starting today. Even modest sums, when regularly committed, possess the potential to grow into something remarkably substantial over time. You absolutely don't require an existing fortune to commence building your wealth through investments. What's truly essential is a well-thought-out strategy and the consistent discipline to adhere to it. So, with these foundational principles in mind, how exactly does one put them into practice effectively? Let's delve into 4 straightforward and actionable steps that can guide your investment approach. The first crucial step is to deliberately schedule your financial contributions, making them a non-negotiable priority. Treat this financial commitment with the same seriousness as you would a vital business meeting or a workout session. Implement automatic transfers that move a set portion of your income directly into your investment vehicle. Arrange for these transfers to occur automatically on your payday, ensuring consistency and ease. This portion of your earnings will flow straight into your savings or retirement fund, bypassing your immediate access. The key is to allocate these funds before you even have a chance to see or consider spending them elsewhere. This powerful technique is widely recognized as paying yourself first, a cornerstone of sound financial management. It represents arguably the single most impactful and beneficial financial habit you can cultivate throughout your life. Over time, these consistent investments have the potential to grow into something truly substantial. You don't need vast sums to begin. What's essential is a clear strategy and the discipline to stick with it. So, how do you put this into practice effectively? Allow me to outline 4 actionable steps to guide you. The first step is to schedule this financial commitment, much like you would an important appointment or exercise session. Ensure these transfers are automated to coincide with your paychecks, directing funds straight to your investment vehicles. This mechanism ensures your money begins its journey towards growth before it ever becomes available for discretionary spending. By automating this process, you effectively eliminate the need for conscious decision-making and sidestep potential temptations. Your allocated funds will then flow to their intended destination effortlessly, without requiring your constant attention. Think of it as your money consistently starting its rest shift, diligently working for you in the background. The second crucial step is to safeguard these funds, as life inevitably presents various interruptions and allurements. These might manifest as enticing sales, spontaneous vacation plans, or even an exclusive investment tip from new acquaintance. You must protect your money's dedicated growth period with the same vigilance you'd guard your essential sleep, establishing clear boundaries. A practical boundary is maintaining distinct accounts for your investments, completely separate from your everyday spending funds. Implement a 48-hour rule for yourself before committing to any financial decision that wasn't previously budgeted. This pause allows for careful consideration, ensuring impulsive choices don't derail your financial progress. If, after those 2 days of careful consideration, the financial decision still feels right and justified, then proceed with confidence. However, what you'll often discover is that the initial, intense impulse or urgency gradually diminishes over time. As that immediate pressure subsides, so too does the risk of making an ill-advised or regrettable financial choice. Our third crucial principle for managing your money's rest is to actively experiment with your investment approach. Just as personal rejuvenation methods vary, not all investment strategies yield the same results for everyone. It's important to recognize that no single investment type will perfectly suit every unique financial circumstance or individual. For instance, if you're younger and possess a higher tolerance for market fluctuations and risk, your strategy can be more dynamic. This might involve a greater allocation towards growth-oriented stocks or diversified index funds, seeking higher returns. Conversely, if you're nearing retirement, your financial focus will likely shift towards preserving capital and ensuring greater stability. In this phase, investments such as bonds or reliable dividend-paying stocks could become a more suitable choice for your portfolio. Perhaps the tangible nature of real estate investments particularly appeals to your financial philosophy and goals. Or you might prefer the ultimate simplicity of a target date fund, which automatically adjusts its asset allocation over time. As time progresses, that initial urgency often diminishes, helping you avoid those impulsive, poor choices. Now, for the third point, it's crucial to experiment, as not every approach suits everyone. Just as different forms of rest vary in effectiveness, so do investment strategies for diverse financial circumstances. If you're younger and comfortable with higher risk, you might prioritize growth stocks and broad index funds. Conversely, those nearing retirement often require more stability, making bonds and dividend stocks a suitable choice. And as we've discussed, if real estate truly excites you, delve into exploring it further. Alternatively, embrace the straightforwardness of a target date fund, allowing it to adjust your portfolio automatically. The key is to try various options to discover what truly aligns with your risk tolerance, timeline, and personal goals. What truly matters is making a start, then continuously adapting your strategy as you gain more knowledge. Moving to our fourth significant point, it's time to release any lingering guilt you might be holding on to. Don't feel bad for not constantly checking your portfolio or for preferring simplicity over overly complex strategies. Financial media often fosters this sense of inadequacy, aiming to keep you engaged, clicking, and spending on their services. Yet, the reality is quite different. The most successful long-term investors frequently achieve results by doing very little. Their approach involves establishing a solid strategy, funding it regularly, and then simply letting it work. This hands-off method allows their investments to grow without constant interference, proving effective over time. The key is to simply begin somewhere, then fine-tune your approach as you gather more knowledge and experience. A critical step is to actively shed any feelings of guilt regarding your financial choices and actions. Stop chastising yourself for not perpetually doing more or for not engaging in every complex financial strategy. True success in investing isn't achieved by being the busiest participant, but by demonstrating the greatest patience. I understand that this financial counsel might not strike you as particularly thrilling or groundbreaking. My aim isn't to present a quick scheme for multiplying a small sum into a fortune in a matter of days. That simply isn't how genuine, sustainable wealth is accumulated in the real world. Authentic wealth is built much like proper rest, slowly, with clear intent, and completely free from guilt. You wouldn't attempt to run a marathon without first ensuring you've had sufficient sleep and preparation. Similarly, you wouldn't work 7 days a week expecting your body to endure without eventually breaking down. So, why would you apply a different, more demanding standard when it comes to managing your money? Allow your money a dedicated space where it can settle and remain undisturbed. Provide your investments with the necessary time to recuperate, grow, and strengthen over the long term. Grant it the freedom to compound, to expand naturally, and to diligently work for your benefit. This ensures it thrives instead of being constantly pulled and pushed by frequent, impulsive interventions. Ultimately, the most crucial trait you can cultivate for financial success is unwavering patience. We understand that this particular approach might not sound like the most exciting financial guidance you've heard. You won't find us promising a quick transformation of a small sum into a fortune by the end of the week. That's simply not how the process of building genuine wealth truly operates in the real world. True financial prosperity develops much like authentic rest, gradually, with purpose, and completely free from any guilt. Consider how you would never attempt to run a marathon without ensuring you've had sufficient sleep beforehand. Similarly, you wouldn't push yourself to work 7 days a week and expect your body not to eventually break down. Given these analogies, why would you approach the management of your money with a completely different, harsher standard? Provide your capital with a dedicated sanctuary where it can truly settle and remain undisturbed. Grant it the necessary duration to recuperate from market fluctuations and strengthen its position over time. Allow it the freedom to compound, grow, and work diligently for you, rather than being swayed by every impulse or fleeting headline. Your financial assets don't require constant additional efforts. Instead, they thrive with a place for calm repose, like a hammock. So, take action now and create that stable, restful environment for your investments to flourish. If this discussion has shifted your perspective on wealth, please hit the like button and subscribe to our channel. At Wealth Logic, we unveil effective financial strategies, focusing on pure logic, free from hype or noise. Join us next time.